to a short series I'm gonna call What the Hell is Going On Out There. Just gonna make a few videos to cover some finance related current events. Hopefully this will replace some of the things that we would have talked about in class anyway. Things like what's going on with the stock market, what's happening to interest rates right now, what's an oil price war. These are kind of things that we would generally just talk about during class at some point. Given that these are all video lectures, there won't be a lot of times for questions and things like that. So just consider this part of the general education that you should be getting from this course in finance. And the first video that I want to cover is about what happened in the stock market over the past few weeks. So first, the basics. You've probably seen, given that it's been all over the news, that the stock market has fallen pretty precipitously over the last few weeks. But what does that actually mean? Well, when someone says the stock market has fallen, or tumbled, or crashed, what they really mean is that on average, the prices of stocks that make up the market have decreased. And remember that stock price and company value are one and the same. So if the stock prices are falling, by definition, the company value is falling, because the company value is just the sum of the stock prices. So if we own stock, in which case we own a piece of the company, this is going to affect us in a big way. And prices have fallen. Over the past few weeks, the market has fallen by nearly 30% from its record high in February. That's one of the worst 2-week periods in history. And not only have stock prices fallen on average, they've also been extremely volatile, which means that prices have gone up and down and up and down and up and down and up and down. In fact, in one 3-day period last week, we saw the market have its biggest one-day drop on record, followed by one of its largest one-day gains, followed again by one of its largest one-day drops. With that kind of volatility, investors just don't know where to turn, and until the market can make up its mind and find some kind of equilibrium in prices, we're going to see a lot of people and a lot of worry. What that means for us as individuals is that almost everyone with a retirement account, including myself, just saw 30% of their money evaporate over the last few weeks. And many people are understandably very worried about that. Now, what the hell caused all this? Well, part of that is obvious. The pandemic that's caused us all to be meeting online has also wreaked havoc on the economy, in some direct and indirect ways. You've probably seen or heard some of the direct effects. For instance, airlines are canceling flights, hotels are empty, bars and restaurants across the world are shuttering. Some grocery stores are running out of toilet paper, and that means some assholes are going to be cleaner than others. All of these things affect a company's value, and most of them have a negative impact. If American Airlines has to cancel 75% of its flights, it's not going to be bringing in any revenue, and thus it won't be making any profit. And since dividends are paid out of profit, they're certainly going to struggle to continue to pay the dividend that they've been paying. And what that means is, since prices are the present value of the future dividends, if American Airlines has to stop paying dividends, its price will go down. The not obvious things are those whose impact are going to be felt long after the crisis. Things like all of the employees of the bars, restaurants, and airlines that have been or will be laid off. If they're not earning an income and they're not spending that income out in the economy, everything else is going to have a trickle-down impact. We're going to see massive effects of people being laid off in the U.S. over the next few months, if the crisis continues. Or the supply chain disruptions that will be felt unless the Chinese economy gets back on its feet and starts producing all of the many things that every other company in the world uses to do business. If your company is waiting on widgets from China to finish building bicycles or whatever it else is you build or sell, then you're just as stuck as if your own production lines have been halted. Companies from the US and South America and all over Europe and Africa all use products in their supply chain made in China. And so a problem in the supply chain is going to cause massive, again, ripple effects into the broader economy. Now, what's the bottom line here? It's that all these things together are contributing to the financial panic that's roiling markets at the moment. All of these things make it much riskier to own and run a business than just a few short weeks ago. And remember one of our fundamental rules of finance. Risk and return go hand in hand. So as risk goes up, so does the required rate of return demanded by investors. And the required rate of return is the rate that we use as the discount rate when we take the present value of a cash flow. And so as the discount rate goes up, because risk is going up, the present value of the future cash flows delivered by these companies goes down. And since the price of an asset is simply the sum of these present values, if the present values have fallen, so has the sum, and the price of these stocks is falling. We see prices fall, and we have, in this case, fall and fall again. So what can we do? The short answer is we can't do much. If you look at a graph of the average price in the stock market over the last 100 years or so, it's mostly going to look like a line that has gone continuously and slowly up over all that time. But we know it hasn't. There have been many similar crashes and crises, including the Great Depression, the 1980s savings and loan crisis, and the 2008 financial crisis. But even accounting for all those crises, the market still averages 8 to 10% per year on a risk-adjusted basis. That means that prices, on average, of stocks go up 8 to 10% per year. We know that that doesn't happen every year, but again, this is an average. All of these crashes are just blips on the slow, steady rise of the market. And everything suggests that this will be just one more blip. So what can we do? We do as Warren Buffett does. We buy and hold for the long term. We don't try to time the market. We don't try to buy when things are good and sell when things are bad. We try not to panic. On average, people lose money trying to time the market. You buy at the wrong time and sell at the wrong time. If we don't get scared, we don't lose money. I find it better, personally, just to avoid looking at my retirement account altogether. After all, I won't need it for 40 years.